The first month of summer, as well as one of the worst quarters for the stock market, has come to an end. During this time, the main US stock indices were down due to fears of a recession. Galloping inflation forces the Fed and other major central banks to tighten monetary policy, raising the benchmark rate. However, this move may result in a slowdown in economic expansion. The Dow Jones and the S&P 500 registered the steepest quarterly fall since 2020. The NASDAQ posted the biggest losses since 2008. Since April, the Dow has declined by 12% and the S&P 500 tumbled by 17%. The NASDAQ plummeted by 23% in 3 months. Thus, the first half of the year turned out to be the worst in more than a half a century. Stocks slid into a bear market, and judging by the current conditions, difficulties for the equity market are not over. Analysts have been speculating for a long time about the possibility that shares have already reached the bottom, yet a trend reversal may occur only if inflationary pressures ease. Last week, several economic reports were in the limelight. Nevertheless, they only intensified market uncertainty. This week, traders are looking forward to the non-farm payrolls report and the FOMC meeting minutes. Watch our video reviews to stay up to date with the latest market news. Feel free to leave comments down below. The main US stock indices were mostly in the red last week. Recession fears have increased again because of the weak economic reports. GDP figures for the first quarter of 2022 were expected to remain unchanged. However, according to the third estimate, real GDP decreased at a seasonally adjusted annual rate of 1.6% versus the forecast reading of 1.5%. Naturally, such downbeat data fueled pessimism in the market. The report confirmed investors' fears about a slowdown in economic growth. Yet, there is a possibility that stocks may halt their drop. The Fed could become less hawkish or take pause in its monetary tightening cycle after September. Apparently, the stock market hasn't reached the bottom yet, so it will continue to decline. What's more, speculators were taken aback by the negative report on the US manufacturing PMI. The index dropped to a 2-year low of 53. The reading undershot the forecasts. Although the figure is still above 50, there are plenty of reasons for pessimism. The economy is going downhill. It means that traders may see far weaker indicators quite soon. And now let's move on to the stock indices. Like two other major stock indices, the Dow closed Friday, the first day of the third quarter, in positive territory despite negative data. Shares reversed early losses amid low market activity because of the long weekend. On Monday, trading floors in the US remained closed on the occasion of Independence Day. However, it didn't significantly change the overall weekly results. The Dow slid by 1.3%. Wall Street is desperately trying to regain momentum, yet disappointing economic reports increased recession fears. They continue to weigh on market sentiment this week. FX strategists provide different forecasts about the possibility of a severe economic downturn in the US. According to a more optimistic scenario, there could be a short and shallow recession in 2023 or 2024. Analysts believe that a strong labor market will help the economy withstand difficulties. Therefore, investors are waiting with bated breath for the NFP report, which is on tap on Friday. As for the Fed meeting minutes, traders hope to find clues about the regulator's future plans on rate hikes. Fed Chair Jerome Powell said that the central bank is ready to use all monetary tools at its disposal to curb inflation. Fighting inflation remains a top priority, even despite the threat of a recession. Speaking at the ECB's annual forum in Portugal on Wednesday, Powell acknowledged that the regulator would face certain challenges in its attempt to rein in inflation. The more hawkish the Fed, the louder their forecasts of a recession. A weak report on the labor market, namely a drop in new jobs, may force the Fed to put on hold its aggressive tightening. If so, it may improve investor sentiment and trigger a rebound. Investors remain alert despite the fact that the S&P 500 jumped by more than 6% last week. The index has already performed 3 rebounds this year after sharp declines. However, it seemed that the index began to recover only for the sake of falling below its previous low. Last week, the index sank by 2.2%. Given the current downtrend, this decline was rather predictable. In the first half of the year, the index decreased by 26%. It also shed 17% in the second quarter. The S&P 500 posted its fourth worst first-half performance on record. Analysts know that the next few weeks the index may slightly rise amid the rebalancing in portfolios. The nearest support levels for the S&P 500 are located in the range of 3,600–3,660. According to some forecasts, the S&P 500 may advance in the third quarter to the levels of 4,000–4,100. If so, it will be a counter-trend rally. After the jump, the index may resume the downward movement. As a result, it could drop below 3,500. Morgan Stanley assumes that the S&P will plunge by another 10% before bottoming out in the current bear market. In the near term, the S&P may face pressure not only because of concerns about economic growth. The earnings season starts in 3 weeks. This is why companies are likely to revise their earnings forecasts significantly. Thus, earnings per share estimates may continue to decline. If firms downgrade their revenue estimates, the S&P 500 is sure to decrease considerably. The heavy tech NASDAQ dropped by 4.1%, notching the biggest weekly losses. Its performance in the first half of the year was rather disappointing, perhaps even worse in comparison with other major US stock indices. Since January, the NASDAQ, which moved into negative territory, has lost 29%. It rolled back by 32% from a high of November 19, 2021, logging the strongest percentage drop on record. It's quite difficult to make predictions for the second half of the year. Given rising inflation and aggressive rate hikes, the economic outlook can hardly be called bright. An economic downturn seems inevitable. Some indicators are already signaling the beginning of a technical recession. According to the latest survey conducted by Deutsche Bank, about 17% of respondents believe that the recession will start this year, while another 13% are sure that it has already begun. Last week, the shares of retailer Kohl plunged by almost 20% after the publication of downbeat profit forecasts. Micron stock sank for a similar reason. The company announced a drop in demand for RAM and flash memory. However, demand for server and specialized memory remains buoyant. Micron plans to expand its presence in the automotive market amid the shortage of semiconductors. That's all for now. Subscribe to our channel and keep close tabs on market developments. See you!